Jamie Dimon says that he does not want to bail out any more banks. Jamie Dimon is the CEO of JP Morgan Chase Bank, and recently, when First Republic Bank collapsed, Chase Bank was the one that stepped up and purchased the failed assets from First Republic Bank. Now, Chase Bank was able to get a great deal. They bought the bank and the assets for pennies on the dollar, but just recently, Jamie Dimon came out and said that he does not want to do that again. Now, you might be wondering why, because it was a good deal for the bank. They were able to buy an asset for pennies on the dollar. Here's what he had to say. He says that people keep looking at the financial deal. Forget the financial deal. When he's talking about the financial deal, he means buying the bank for pennies on the dollar. He says, we have 800 people working around the clock on this, 10,000 people deployed to consolidate systems, risk, fraud, credits, payments, branches, real estate vendors, technology. It's a lot of work. So what he's saying is, yeah, they were able to go out and buy this bank for pennies on the dollar, but then they have to deploy thousands of people to go out and figure out how to make the deal work. And he does not want to continue to keep piling on this work onto his employees when they have other things to do. And the returns apparently might not be big enough to justify that return. He went on to talk about the benefit of buying First Republic Bank for the stock itself. What he said is that First Republic's assets were marginally beneficial for shareholders, which is why he went out and bought the stock. Now remember, the CEO of a company has a fiduciary duty. They have the duty to increase the stock price of the company. That is the goal of the CEO. That is your job. How do you increase the stock price of a company? Well, you got to make bigger profits. What's one way they can make bigger profits? Well, you can sell new products, you can raise your profit margins, you can cut costs, or you can buy businesses. One way that they did that recently was by buying First Republic Bank. Now, to give you some numbers on the First Republic Bank asset, I think that'll help explain this a little bit more. Jamie Dimon bought First Republic Bank for $10.6 billion. And about 12 months ago, First Republic Bank was valued for around $30 billion. So they got a pretty good deal on First Republic Bank. But what he's saying is the amount of work that's required to manage the takeover, to deal with the process and the regulatory issues, he says is not worth it. He said it was marginally beneficial for shareholders, but not that much to justify all the extra work required. Now, the reason why this is so significant isn't just for the Chase Bank stock or the company, but rather for the broader economy. Because when the First Republic Bank collapse happened, there was a lot of pressure from regulators like the FDIC, the Fed, the Treasury Department, telling private banks like Chase Bank to go out and make an offer to purchase the assets of this new collapsed bank. And the reason why is because if a bank collapses and a private bank doesn't take it over, like if Chase Bank didn't take over First Republic Bank, then that would mean the FDIC would come in and they would have to then take the assets from First Republic Bank. And if FDIC is taking the assets, that means the government and taxpayers are on the hook for all the depositors. Because remember, FDIC insurance protects you up to $250,000. And right now it's really unclear whether or not there is a limit to FDIC, because the government has essentially said that they will protect all depositors until further notice, which means that the FDIC will have to pay out all deposits lost. And the FDIC doesn't have that much money. So where would the FDIC get the money to pay out depositors if they don't have that money? Well, the FDIC is backed by the full faith and credit of the United States government. And the United States government isn't sitting on a big cash pile. We're in debt. And we have a huge national deficit. So how does the national government get the money? Well, we print the money with the help of the Federal Reserve Bank. So if First Republic Bank collapsed and FDIC took it over, then that would essentially mean that there would be more money printing in order to fund the deposits that the FDIC would have to pay out. That would be inflationary, that would affect the taxpayer, and it would affect more citizens because of that. So that's why there was a lot of pressure by regulators to get a private bank to come out and take over the bank. Now, we did a whole deep dive of this in Market Briefs, my free financial newsletter. Right now, we have a daily banking section in our newsletter because right now we're seeing what's going on with PacWest. PacWest is struggling a lot. I'm going to talk about them in just a second. And this banking crisis is far from over. So if you want to stay up to date on what's going on with the banking crisis, the economy, the stock market, the housing market, crypto, and the global economy, it's a fun and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to join Market Briefs, I got the link to how you can join for free down in the description below. But this is where now, when Jamie Dimon was talking about whether he would purchase more failed banks, what he said was, no, I doubt it. I mean, we're going to have a lot of blowback having bought this one, First Republic Bank, but if it was the right thing to do, or it was the right thing to do, but to buy First Republic Bank. So he's not interested in buying more banks, which means if we do see more failed banks, which it seems like we will, there's going to be potentially less interest from other banks. I mean, Chase Bank is the largest bank out there here in the United States, which means less interest from private banks to purchase some of the failed banks. And part of the reason why is the work, but the second reason is regulatory issues. And the way that you can best understand that is just to back up and see what happened in the previous recession. Because when the 2008 crash happened, we saw banks like Bear Stearns and Washington Mutual collapse. And that was where Chase Bank did come in, and they took over Washington Mutual. And they also took over Bear Stearns, or some of the mortgage-backed securities. And that also meant that JP Morgan Chase Bank took on all their liabilities. So these banks collapsed. Jamie Dimon and JP Morgan Chase Bank went out and bought these banks. And then in 2013, JP Morgan had to pay a $13 billion fine for two regulators, because of problems from the mortgage-backed securities at Bear Stearns and Washington Mutual. So Chase Bank went out and bought these failed banks as a way to kind of help save the economy, buy these assets for pennies on the dollar. There was a lot of pressure from the Fed and the Treasury Department to Chase Bank to buy these banks. They did. And then because Bear Stearns and Washington Mutual had issues with mortgage-backed securities, they got into a lot of trouble with these mortgage-backed securities. Who had to pay the $13 billion fine? Chase Bank. And this is where Jamie Dimon is saying he doesn't want to have a repeat of these types of issues. So now he's potentially steering away from purchasing more of these failed banks. So we'll see where that goes on the Chase Bank side. But then on the current event side of the banking sector, we're now seeing the PacWest Bank get hit hard again, which is really not that surprising. I've been keeping you posted on what's been going on with PacWest here. And PacWest Bank has been struggling a lot. They originally started struggling because when First Republic Bank collapsed, people started pulling their money out of PacWest. And that was hurting the bank itself, because now they had less deposits sitting there. And as people pulled their money out of PacWest, they were able to kind of calm the noise. They said that we don't have a huge amount of deposits leaving. It's not an unusual amount. But then they had to release their earnings statement. And when they released their earnings, they disclosed how much cash was pulled out of their account or their accounts. And that's when investors panicked and they started selling off the stock. And when they started selling off the stock, that was when I really started covering it. That was when PacWest again said, don't worry, everything's okay, deposits are safe, which was an interesting thing for them to say, because like I was saying here, when you see the stock of your bank, like if I had my savings at PacWest and I see their stock collapsing, falling 30 to 50% in a day, I'm naturally going to be worried as somebody who saves my money at PacWest. And I would be more inclined to then want to pull my money out of PacWest and put it somewhere safer, where I know that it's more secure. And PacWest denied that initially, saying that no, their deposits are safe. Well, recently, this week, PacWest announced how much people pulled out of their deposits last week. And when investors heard this number, when they heard that between 7 to 10% of their deposits were pulled out in just 1 week, the total bank deposits in 1 week, investors heard this, got scared again, and then we started to see the sell-off of PacWest again. So that's a double punch to the company, because one, when the stock price falls, the valuation of the company falls, and makes it more difficult for them to go out and raise more money if they needed to. On the second hand, when people pull their money out of the bank, that gives them less operating capital. It gives them less money to continue running their operations. It gives them less money to go out and make loans, which means they have less ways to make money. And if they have less ways to make money, well, that makes it harder to stay in business. So PacWest is going through a lot of struggles right now. They're not the only bank. There's a lot of regional banks that are going through similar processes. And it ultimately comes down to what's going on with interest rates, because the higher interest rates have been putting a lot of pressure on banks. Number one, it makes people borrow less money. And then number two, it makes the assets that many of these banks are holding on to drop in value. And many banks are holding on to underwater assets, making it even harder for them to go out and raise money. So the banking crisis is not over. We got some interesting news from JP Morgan and Jamie Dimon. And this is where now, again, you want to stay prepared and understand what's going on, and just know that this banking crisis will continue. And if you want to stay up to date, we'll keep you posted on market briefs. And I'll be doing the same here as well.